Short Squeeze Deep Dive. Bull and bear cases for PETGX, USAR, ASBN, CDXS, GLUE, and CATX. Welcome to Market Moves and Short Squeeze, the podcast where we spotlight the hottest short squeeze candidates and break down the bull and bear cases you need to know. Whether you're a day trader looking for the next rocket or a long-term investor separating hype from substance. I'm your host, and today we're diving deep into 6 intriguing tickers: Protagonist Therapeutics, PETGX, USA Rare Earth, USAR, Aspen Aerogels, ESBN, Codexis, CDXS, Monte Rosa Therapeutics, GLUE, and Perspective Therapeutics, CATX. Each name has been making waves, some with soaring gains, others with steep falls, and all with technical setups that have short sellers and bulls facing off. We'll cut through the noise, analyze technicals, fundamentals, and those all-important 52-week high/low scenarios, and translate the quant jargon into actionable insights for a podcast you won't want to miss. So, whether you're scanning for the next big squeeze or looking for stability in the storm, stick with us. We're about to pit the bull and bear cases head-to-head, one stock at a time. I'm your host, Jack. Let's get started.
Segment 1. Setting the scene. What's driving short squeeze hype? Host. Before we jump into each of our 6 stocks, let's quickly set the stage. What makes a stock ripe for a short squeeze? And why is it so often the battleground between the brave and the reckless? Explanation. A short squeeze happens when investors betting against a stock, short sellers, are forced to buy shares, often rapidly, to cover their positions due to a price surge. This frantic buying drives prices even higher. Technical factors like rising short interest ratios, low floats, and volatile price action are classic ingredients. But under the surface, fundamental catalysts, think FDA decisions, government contracts, or strategic partnerships, can flip the script overnight. We'll examine each stock using 4 lenses. Technical analysis. Are the charts lighting up with buy or sell signals? Quantitative signals. Are trading volumes and short interest sending alarm bells or buy warnings? Fundamental analysis. Is the business solid or speculative hot air? 52. Weak high/low scenarios. How does the current price stack up against the past year's extremes? And what does that mean for traders and investors? Get ready. Let's jump into our first stock, Protagonist Therapeutics, ticker PETGX. Segment 2. Protagonist Therapeutics, PETGX. Pharma rocket or risky bet? PETGX, the bull case. Host. Protagonist Therapeutics has been the talk of the biotech town, and for good reason. The classic setup: big clinical catalysts, a pipeline on the cusp of commercialization, and recent price action that would make even seasoned traders do a double take. Recent trading saw PETGX leap 31.6% in just 2 days, following positive FDA designations and key clinical trial wins. The company's flagship drug, Icotrokinra, is showing strong Phase 3 results for both ulcerative colitis and plaque psoriasis. No small feat in biotech. Fundamentals are a highlight. Despite the sector's usual money-burning reputation, PETGX boasts a 22.2% EBIT margin and 100% gross margin on $434 million in revenue. The current ratio? 17. That's robust liquidity, and their debt-to-equity sits at a featherweight 0.02, allowing for continued research investments without balance sheet anxiety. Strategic partnerships are also adding fuel. Collaborations with giants like Johnson & Johnson not only validate their science, but offer a credible shot at global commercialization, fueling analysts overweight and buy ratings with price targets ranging from $67 to $80. Technical analysis flashes bullish signals. The 200-day and 100-day moving averages are above current levels, and a wave of buy indicators have lit up recently. The chart's momentum is undeniable, especially as the stock broke past previous 52-week highs, a classic catalyst for speculative buying and short squeezes. And let's not forget, PETGX recently registered a closing price well above prior highs, climbing from the high $50s into the high $80s over October, triggering by stops and panic among the shorts. Narrative. For the bulls, PETGX is entering its breakout phase. Fundamentally solid, technically strong, and with unique assets that analysts say are still underappreciated in the biotech landscape. There's also asymmetric risk-reward, a firm with both near-term catalysts and long-term optionality from multiple clinical assets. PDGX, the bear case. Host, but it's not all blue skies. The bear case for PGX boils down to three main risks. First, valuation. At a PE above 70, and with forward multiples lagging but still high, some quants argue the stock is getting ahead of its fundamentals. DCF models point to intrinsic values far below current prices, despite recent wins. Second, the volatility of expectations. Biotech success rides on approvals and market uptake. Just one negative trial or an FDA setback could have the stock overnight, and history is filled with high-flying biotechs that crashed out of orbit when reality intruded. Third, recent insider sales. Notably, major insiders, including the CEO, have trimmed positions in the past quarter. While not always ominous, such moves amid a breakout spike can spook momentum traders and signal a short-term top. Technical risks are also present. While the long-term trend is bullish, recent stalling at elevated levels near $88 hints at possible resistance. Sell signals on some moving averages and a neutral RSI suggest the stock could be running hot and due for a pullback. 52-week high/low scenario. Having set a new 52-week high, PGX faces potential profit taking. If it fails to hold above the breakout level, a reversal to the mean could add pressure, providing ammunition for short sellers looking for exhaustion plays. Transition. So for PGX, the battle is between breakout optimism, fueled by clinical wins, partnership momentum, and technical breakouts, and valuation worries and profit-taking after one of the sector's most dramatic runs this year. Segment 3. USA Rare Earth, USAR. National Security Play or High-Risk Spec. USAR, the bull case. Host. Next up, USA Rare Earth. Ticker USAR. A name that shot into the spotlight amid geopolitical drama, government whispers, and a scramble for mining independence. 2025 has been a year of transformation. USAR shares have more than doubled, rocketing 120% plus year-to-date after the company landed in close communication with the White House. The catalyst? The U.S. government is actively exploring investment options, following moves earlier this year in Lithium Americas and MP Materials. USAR's pitch. Vertical integration. They are building the only fully domestic mine-to-magnet rare earth supply chain, an urgent need as lawmakers seek to decouple from Chinese critical materials. The company now controls the Round Top deposit in Texas, bought the UK's less common metals, adding rare earth metal expertise, and is on track to complete a US-based neomagnet factory ready for production in 2026. Financial resilience. While still pre-revenue, an important caveat. USAR is sitting on $122 million in cash and zero debt as of mid-2025, following a major capital raise. Leadership added heavy hitters this year, most notably Barbara Humpton, ex-CEO of Siemens USA, signaling serious intent and government savvy. Technical and quantitative signals. USAR's sharp volatility, plus daily trading volume surges on major news, mirror a classic short squeeze environment. The scarcity, premium, and strategic narrative have transformed it from a niche developer to a front-page momentum play. Short interest is not extreme, but moves are being driven by outright buying and news catalysts. 52-week high scenario. The recent breach of all-time highs, $26 to $27 range, after confirmation of White House talks, sent the stock careening into heavy buy territory, with analysts scrambling to raise targets and traders buying every dip on news-fueled optimism. Narrative. For the bulls, USAR is a future keystone of American tech and defense independence, riding a rare alignment of political, industrial, and investor incentives. The mine-to-magnet innovation, early offtake agreements, and high-level government engagement set the stage for future multi-bagger potential. USAR, the bear case. Host. But with great upside comes great risk. First, execution. USAR remains pre-revenue, burning cash as it races to build out mining and manufacturing operations. The going concern footnotes and filings cannot be ignored. More capital raises or government support will be needed to bridge to commercialization. Second, dilution. Already, shares outstanding have climbed sharply in 2025, and further equity raises remain a risk. Early-stage hardware projects often run over budget, and delays or overruns could trigger rapid downside. Third, competition and geopolitical risk. While USAR's government ties are impressive, rivals like MP Materials have deeper experience, and regulatory headwinds or shifting policy winds could shift sentiment quickly. Technical signals. The meteoric ascent means the stock is highly susceptible to event-driven declines. After nearly doubling in a straight line, even a routine setback, like a project delay or competitive update, could prompt sharp pullbacks. Pullbacks in August reflected this when reports surfaced about rising competition and USAR's quarterly loss. 52-week high/low scenario. Having set new highs, USAR is one negative headline away from a meaningful correction. Short-term traders have already seen double-digit downswings after parabolic spikes, underscoring the dangers for those arriving late to the party. Transition. Bottom line, USAR embodies the high-octane mix of macro momentum and execution risk. It's either an American industrial miracle in the making, or a cautionary tale about betting the farm on hype and headlines. Segment 4. Aspen Aerogels, ASPN. EV infrastructure darling or value trap. ASPN, the bull case. Our next feature, Aspen Aerogels, ticker ASPN. The company is a leader in advanced insulation materials, with a special twist. Its products are attracting big names in EV battery thermal management. Think Tesla, GM, and a recently rumored German OEM deal. Despite a rough ride in the market, the bull thesis for ASPN runs on 3 tracks. Growth pipeline. Aspen outperformed analyst expectations in its latest reported quarter, with $117 million in revenue, up 23% over consensus, and $25 million in adjusted EBITDA, a 78% beat. Future capacity. A $670 million DOE loan commitment will supercharge capacity expansion for PyroThin, Aspen's flagship EV battery insulating material. When their new plant comes online, potential revenue capacity could leap to $2 to $2.5 billion. Critical as EV proliferation shifts in a high gear. Market penetration. Aspen's insulation tech is now embedded in both energy infrastructure and next-generation EV supply chains. Management projects $1.5 billion in revenue by 2029, with high demand forecasts from the automotive sector. Technical analysis. As of September/October 2025, ASPN is rebounding off deep lows. The stock sits in a rising trend channel, with support established at $6.68 and resistance at $8.30. Recent chart action shows a buy signal from a double bottom formation, a favorite among technical traders seeking trend reversals. Quantitative sentiment. Analyst consensus remains moderate buy, with an average price target of $19.50, more than double the current $7.96. Volatility is high, but insider transactions and institutional accumulation near the lows signal growing confidence. Narrative. Bulls see Aspen as a turnaround play with technology validated by industry giants, robust government support, and a clear pathway to multi-billion revenue, a classic by the dip candidate in clean tech infrastructure. ASPN, the bear case. Host. The bear argument won't be silenced, and for good reason. First, financial execution. EBITDA is up, but net losses remain persistent, and the company's negative net margin, minus 78.5%, alarms the value crowd. The debt-to-equity ratio has improved, but subpar cash generation means even small operational missteps can send ASPN back to the capital markets for fresh funding. Never a bullish signal in a risk-off tape. Second, downgrades and analyst caution. Barclays shifted from equal weight to underweight and can accord Genuity trim price targets. The company has missed growth targets previously, causing analyst confidence to be tested, especially as volatility remains high. Third, stock volatility and technical ambiguity. The stock is hovering in a narrow range after major drawdowns, down more than 7% in a single day in early October, and over 75% from late 2024 highs. A continued failure to break back above $8.30 to $9 resistance would challenge the bull reversal narrative. Short-term traders note high beta and daily swings exceeding 6%. 52-week high/low scenario. ASBN is scraping near its 52-week low, and value investors may be circling. However, a break below technical support could signal a new round of capitulation and short pressure. In summary, Aspen Aerogels is a battleground stock, a high-tech manufacturer facing steep losses, but with the upside of government backing and bullish analyst targets if execution aligns with green industrial tailwinds. Segment 5. Codexis, CDXS, small cap squeeze or structural decline. CDXS, the bull case. Now let's talk Codexis. Ticker symbol CDXS, a small cap enzymatic innovation play that's whiplashed investors all year. Bullish arguments. Value recovery. After a catastrophic drop, CDXS staged a one-year gain of 98%, making it a darling among bottom fishers and short squeeze hunters. Fundamental strengths. Gross margins are sky high, over 80%, and recent free cash flow growth, 121% TTM, shows the company's ability to pivot despite painful restructuring. Insiders and institutions, most notably Opaleye Management, have been gobbling up shares at low prices, flashing confidence despite the wreckage. Valuation opportunities. Price/sales and EV/sales ratios are now among the lowest in the industry, opening the door to multiple expansion if the business stabilizes. Technical setup. Short interest recently surged to 6.24% of shares, with over 5.6 million shares sold short, a setup that attracts squeeze specialists looking for news-driven reversals. Narrative. For bulls, CDXS is the classic small-cap rebound story. High risk, high reward, with enough cash and margin to survive, and just enough hype to catch the next bid. A solid product win or partnership could reignite a speculative rally. CDXS, the bear case. Host, the counter-narrative looms large. Performance. 3- and 5-year returns are atrocious, with YTD and trailing returns in the bottom decile of its industry. Revenue fell nearly 50% year-on-year. Net margins and ROE are deeply negative, and cash burn remains severe. Financial health. Operating cash flow is sharply negative, and the company is reliant on capital raises and cost cuts. Analyst targets, even at $11, are met with skepticism due to macro pressures and internal execution issues. Short/long ratio. Days to cover short interest rose to 5.6, implying that a squeeze could still take time to play out, and downside after fall starts remains real. 0.52. Week high/low. The stock trades at a fraction of its 52-week high, with the technical floor still unproven. In a risk-off market, CDXS could spiral lower without support, especially if industry sentiment sours or another earnings report disappoints. CDXS, then, is the ultimate speculative coin flip, a technical battleground where short squeezes and value buyers battle relentless negative returns and business uncertainty. Segment 6. Monte Rosa Therapeutics, GLUE. Precision medicine moonshot or overhyped biotech. GLUE, the bull case. On to Monte Rosa Therapeutics, ticker GLUE, a biotech innovator in the fast-emerging protein degradation space. Bull arguments. Cutting-edge science. GLUE's technology is hailed as a future disruptor in targeted therapies, drawing investor interest despite pre-revenue status. Fundamentals. Strong cash position, $290 million as of latest filing, moderate cash burn, and a business model with high scientific optionality. Profitability and solvency scores are ahead of many microcap peers. Analyst sentiment. Wall Street's consensus rating is hold, but price targets range from $10 to $21, implying upside of over 200 to 300% from current levels. The average 12-month target sits near $15 to $16, double or triple the recent $4.80 price tag. 2 out of 4 analysts rated a buy, giving the stock speculative appeal at bargain prices. Technical analysis. After a prolonged downtrend, GLUE has entered a counter-trend up phase, with strong momentum indicators on longer-term charts and support forming near recent lows. Short interest is moderate to high for the float, amplifying the potential for rapid rallies on positive data. Narrative: for bulls, GLUE is an asymmetric call option on a scientific breakthrough, the kind of stock that can double or triple on just one clinical success or partnership. GLUE, the bear case. Host: but let's dig into the risks. Valuation premium, but with value caveats. Even after big drops, DCF models peg intrinsic value around $7.14, just 33% above current levels. That's less explosive than the pie-in-the-sky targets often touted for biotechs. Execution: the business burns cash, has no revenue, and faces stiff competition from better-funded peers. If clinical data falters, the story could end abruptly. Technical fragility: despite periodic rallies, GLUE's price action is highly volatile, having dropped over 75% from 3-year highs. Without a near-term data readout or partnership, patience and liquidity could run out. 52 week range. The stock is well off both highs and lows, offering no clear technical breakout or reversal signal. Sellers could step in on any failed rally, and a breach of recent support could set up a fresh leg down. GLUE's narrative is straight from the biotech playbook: maximized optionality, minimum visibility. It's a high-conviction bet where technical squeezes and headline risk rule the day. Segment 7. Perspective Therapeutics, CATX. Microcap marvel or mirage. CATX, the bull case. Finally, let's close with Perspective Therapeutics, ticker CATX, a small-cap medical device hopeful that's come to the fore on short squeeze screens and bottom-fishing radars. Price action: despite being down 74% from its 52-week high, $13.44 to $3.47, CATX has seen clusters of technical buy signals. Recent weeks brought a gain of over 1% after bottoming out, supported by a pivot bottom reversal, a classic accumulation zone for patient traders. Analyst consensus: CATX now earns a strong buy rating, with the average target of $12.90 implying 250% plus upside. Even conservative Wall Street forecasts peg the target at $6 to $20. Institutional sentiment shows scaled-up exposure by heavyweights like BTIG and Millennium Management. Quantitative and technicals: the stock is flagged as a hold/accumulate, with a long-term buy signal still intact. Short interest remains moderate, but the recent rally from oversold conditions could be the start of a reversal, especially if new product or clinical catalysts hit. 52-week scenario: the proximity to the 52-week low, $1.60, provides a supportive base. Bulls see this as a prime, mean reversion candidate, especially if institutional buying or positive news flow accelerates. Narrative: CATX is the quintessential microcap turnaround, battered, below the radar, but with potential technical liftoff if trading volumes and bullish momentum persist. CATX, the bear case. But buyer beware. Fundamentals: no revenue, persistent net losses, and recent guidance indicating further operational challenges. Without new contracts or breakthroughs, cash burn could force more dilution, even as the stock flirts with short-term rallies. Technical risks: despite a recent bottom, the trend has been steeply negative. The next leg could take CATX below key support unless a turnaround develops. Volatility is extreme, and daily range can be as wide as 8%, making tight stops and disciplined risk management a must. Institutional selling: despite some big buyers, overall fund ownership has dipped, reflecting cautious optimism at best. 52-week high/low. Even if the bounce sticks, reclaiming the $13 plus high is a tall order without material business improvement. Sharp rallies could be quickly sold into by bag holders eager to reduce losses. Simply put, CATX is the ultimate high-wire act, a bet on recovery, but vulnerable to any market hiccup or negative surprise. Segment 8. Key takeaways and tactical lessons. Let's distill all that market noise into crisp takeaways for each ticker. PGX, Protagonist Therapeutics bull case, rides high on clinical momentum and partnerships. The bear case: lofty valuations, and the ever-present risk of biotech disappointment. Price action near 52-week highs can be both a springboard for further gains or a trap for latecomers if profit-taking sets in. USAR, USA Rare Earth, a strategic, macro-driven story. Executing on the government's domestic supply ambitions
call to action
could make USAR
that wraps up our
tour
tour
through the wild world of
pre-revenue
short squeezes
status
and battleground
future dilution,
stocks,
hazard
from biotech
outweighs
rockets
the most
to
patriotic
rare
bull
earth
thesis.
gambles, and
ASPN,
everything in between.
Aspen
Whether you're a day
Aerogels
trader
momentum
hunting
is
for volatility,
returning,
fueled
or a
by
patient
DOE
investor
money
looking for
and
durable
EV
trends,
infrastructure hype, we hope today's
but
analysis
unless red
helps
ink
you make
shrinks
smarter
and
new
more
contract
confident
lands.
moves.
If you found this podcast
volatility will
valuable,
keep both
please
traders and
subscribe,
investors on their toes.
leave a review, and share your thoughts. It helps the show
Codexis, a
grow
battleground
and helps us
for
reach
value
more smart
investors
investors
and
like
short
you.
squeezers
Got a
alike.
stock or theme you want
Deep
us to break down
discounts,
next?
high
Drop
insider
us a
buying,
message,
but
structural
we
losses
read
in
every
every
single
momentum
one.
demand.
Thanks for
tuning in to Market
GLUE
Moves and Short Squeeze.
Monty Rosa
Until next
undervalued on
time,
some DCFs,
keep your stops tight, but
and
with
your mind
no
open.
imminent catalyst.
I'm your host.
It's redemption
Trade
lies
safe.
in pipeline news. It's a lottery ticket for bulls and a patience test for bears. CATX, Perspective Therapeutics down, but potentially not out. Analysts are bullish, and technical support is nearby, but dilution, cash burn, and lack of revenue haunt the story. Practical lesson: no matter the hype, technique triumphs. Blend technical analysis, quantitative signals, and cold-eyed fundamentals to separate narrative from reality. Remember, new 52-week highs can spell both euphoria and exhaustion. Approach each scenario with a plan. Capture the trend, manage risk, and don't get married to your position.